Hello members and welcome to today's special webinar. My name is Roger Malik, the host and head of client services for Fat Profits. Thank you for your company today, and joining me in today's webinar is our resource analyst, David Lennox. David, welcome to today's webinar. Has the bull market arrived? How are you?
Hi Roger, I'm certainly excellent, and I hope all our listeners are as well as we go through today's webinar. Has the bull market arrived? Well, 20% supposed to be from its lows is supposed to be the measure. And some of those markets have hit that, so in some markets, yes. We haven't here hit that yet, so for our market, no.
Definitely, that's a common debate in most people's minds at the moment, so we thought that'll be a good topic to discuss. But before we get started, there's a lot to talk about today. What we want to do is just do a quick bit of housekeeping first. As most of our presentations are general in nature, we don't provide any personal advice. So if you are looking for that, please see your financial advisor. And also, past performance is no indicator of future performance. Now, in today's webinar, we do have a Q&A session towards the end of the webinar. So if you have any questions related to our topics or otherwise, please feel free and ask a question by typing them in on your screen. And the other thing we're going to do today in the webinar is we're going to make it very interactive. So let's have a bit of fun today, members. If you've got something to say about our topics, we're also going to look for some feedback today because it's pretty much the half-year point of 2023. So we're going to do a bit of review of how the year has been for you, for us, for the markets, and also several changes we made to the service along the year. So we want to get a bit of feedback from you today to understand how it's working for most people. I mean, you can't please everyone, I guess, in anything, but as long as most people are reasonably convinced that this is the right format, we'll take some feedback on all of that as well. Now, as you know, Angus is away this week, and the daily Fat Chats will start from Monday. So David will be filling his shoes today to discuss the markets with us. So first thing first, let's look at the 2022 performance of global markets versus 2023. As most of you know, and you can see that on your screen now, 2022 was all red, except if you were in the UK, you were probably feeling all right. The FTSE was up, but most markets were down. NASDAQ was the worst in the world, down 33%, but they've recovered substantially this year, up 30%. S&P was down 20%, up 13% this year. If you look at the ASX, we were down a little bit, up a little bit this year, nothing great, which actually is not too bad, actually. You don't want to see too many wild swings. So from that perspective, it's not too bad. But one standout this year is Nikkei, which is Japan, certainly having a very good run. So let's dive into a few markets. First thing first, bulls versus bears. This is the main debate in the markets today. The bulls are certainly having a say this year. Last year was the year of the bear. So let's get the first question across to you is, what camp are you in? So let's get some feedback from you. Are you feeling bullish for this year? Are you in the bearish camp, or are you unsure? And look, no problem if you're not clear, because it's a very confusing market. A lot of people are sitting on the fence and not sure which direction we're going to head to. You would know Fat Profits' view, because we have been providing the daily and weekly updates. So I'm pretty sure you're clear on our stance, but it'll be interesting to see what you think about the markets, because you might have a different opinion, or you may just agree with us. So let's get that question. We're getting quite a few responses. I'm going to close that now in another 5 seconds. If you can quickly jump in, that'd be great. All right, here we are. So the answers are 11% of you who've answered the question are saying bullish, 37% are bearish, and 52% are not sure. So there you go. So half of the audience is a bit unclear. And look, you're not to be blamed. It is a very confusing market. And I'm getting a comment from Lynn saying, I'm getting FOMO. Lynn, you're not alone. There's a lot of people feeling FOMO, missing out. But look, We're going to talk about that next. So let's look at both camps. Let's break it down. The bull case. What are the bulls like? In the 11% of you, what do you like at the moment? So if you're in this bull camp, you'd be happy that the US debt ceiling deal is done, and that would have been a catastrophe if that wasn't. The AI story is certainly a very positive story. We all know that that's the future, and that's propelled the markets this year. Better earnings versus expectations so far. This is not just in the US, but also in Australia, not too bad at this point in time. So that is a bull case. The other big story is the strong labor market. Yes, it's not just in the US, UK, Europe, and in Australia and New Zealand. The strong labor market is something to be positive about if you're in that camp. And of course, inflation has slowed. It has slowed, it has come down, and there's plenty of things to look at. So a couple of things to break it down. Corporate earnings, this is the S&P 500. If you look at the last several quarters, it has come down gradually and slowly, but the highlighted one is the recent Q1 earnings, which were down, of course. So in 2 consecutive quarters, we've seen earnings decline, but it wasn't as bad as anticipated, and that's what moved the markets higher. The anticipation for second quarter is that earnings will drop further. That's from the market consensus. At Fat Profits view is that second and third quarter earnings will drop further than expected, and we are in the bearish camp. But more on that later. So that's one thing to look at. The other thing is, of course, inflation. We know inflation in the US has come down from 9% down to 4%, and that's pretty good. And that's the headline inflation. However, the trouble is that Australia, inflation is still close to 7%, and that's a problem. So locally, we're not in that very happy camp at this point in time. If you look at US core inflation, it has come down from 6.6% at its peak, but down to 5.3%. So it is moving very slowly, pretty sticky around that, above the 5% mark. So the Fed are not happy with this. So this is something which they want to control. Labor market, absolutely, that's a positive. People are still employed, very low changes, both in the US, and you can look at Australia as well, very similar. We're stuck between 3.5% and 4%. Very good, you'll take that any day of the week. Of course, we all want to have a full economy. On the other hand, of course, you know, the bulls who have already gone into that camp, they're feeling pretty good, but you know, there's more to come, hopefully, for those who are fully invested in the market. Let's move on to the 37% of you, including Fat Profits, and we'll add ourselves in that camp, and myself included, the bear case. There are multiple things to look at. The first thing is weak market breadth, which means the top 10 stocks out of the top 500 have really been driving the market. So it's not a typical bull market unless everyone's participating at the same time. The other thing is the hawkish Fed. The rates have not finished, the rate hikes, I should say. They're not done yet. And Mr. Powell is in the Congress today, and he mentioned the same thing. We're looking at another 1 or 2 rate hikes. So even in Australia, probably not finished yet. Inflation, while it's come down, is still pretty sticky. We think it's still going to be a long time before it's completely down to 2%. And until such time, we don't think the Fed or the RBA will cut rates. So that's still at least 6 to 12 months away. Credit tightening, yes, that's happening, and that slows the economy right down. The biggest one out of all of them is the inverted bond yield curve, and more on that in a minute. And leading economic indicators are down, and this is another key point. So a couple of things. The S&P 500 market breadth is at its lowest point in the last 20 years. This is not a typical bull market. Last 14 times, the Federal Reserve have had a rate hiking cycle. 11 times, the economy has landed in a recession. It's not 100%, but the odds are certainly in a recession camp. So you'd be doing well to go against the odds. The leading economic indicators, which is another very accurate sign of a recession ahead, is certainly dropping and going down as we speak. So you can see that the current one. In previous times, you can see historically there have been recessions followed. and this is the big daddy out of all of them, is the bond yield curve inversion. And that simply means the short-term bond yields versus the long-term bond yields are higher, and they're basically, if you invert them, they're in negative territory. And they're actually getting worse as we speak. Even overnight, there is a full 1 percentage point difference between the short-term 2-year bond yield versus the 30-year bond yield, and that is has not happened since the 1980s. So that is a flashing red sign. And finally, unemployment, and this is a key point, because until the labor market really slows down, the Federal Reserve or the Reserve Bank are not going to cut rates. And this chart is very interesting, and you've probably never seen this one before. And people are asking, well, how long does it take for the labor market to break? Well, this really proves to you, this is from 1962 till 2023. So typically, it takes a total of 18 months. And what has happened so far is the first, and I'll point the mouse here, after 10 months is when you really start to see unemployment rise. This is based on, well, close to 80 years of history. So after month 10 is when, on an average, the unemployment starts to rise. And what month are we in? This all started in August last year when the bond yields inverted. So we are in month 8 at the moment. Actually, no, month 9, I apologize. So over the next 1 to 2 months, we can start to expect the unemployment to start rising. This is again based on historical stats. It's not always to the dot, but expectations would be in the next 1 to 2 months, we should expect the unemployment to start rising, and it peaks in another 6 to 9 months. And that's when we're going to see it really come to a fruition in terms of Federal Reserve, and that's when we expect them to start cutting rates. So that's something for first half of next year. And the final thing before I move on to David is the jobless claims, and this is another thing which we get on a weekly basis. This is starting to rise slowly, but it really picks up after month 10, 11, and so on. So this is another thing which we're expecting to rise. And if you look at a slightly different chart, this is jobless claims, and you notice this is starting to pick up. We think another few months and this will start to rise. And you can see in previous recessions, 2008, it started to rise, 2000, it started to rise, and it's just starting to rise now. So we think that's a shoe which probably will be the final shoe to drop in this particular cycle. And to finish this off, a bear market cycle goes in 3 phases. First, second, which we've seen already. These 2 phases were last year. The third and final phase is what we're waiting for. And that's the biggest one normally. This is, again, historical numbers. You can see all of that. And that's usually more than 20%. If that was to happen again before the end of this year, then it will present good opportunity for those of you who are looking and waiting patiently. On that note, I'm going to pass it on to you now, David, because S&P 500, let's start talking about the markets. And feel free if you've got any points to add to the bear and bull market case, but quickly on the S&P 500, and I'll pass it on to you, this is how we were looking up until October last year. So this chart is until October. Quite bearish, down 20%. And yes, the expectation was that this will continue until we get to the final bottom. What's happened since then? We've seen a recovery of 20% from the absolute lows of 3,600. So on that note, David, over to you. What are your thoughts on the market, and how do you feel about the bulls versus bear case?
Well, primarily, I guess if you have a look at the S&P 500, one would have to suggest that in the early part of last year and towards the end of the year, the markets were very pessimistic. The Federal Reserve was in the midst of rising rates. We'd seen a number of 50 basis point increases that we hadn't primarily seen for some many years, and that was really giving the market a very, very big amount of I guess pessimism, and we saw the markets react accordingly to the downside. Markets then started to look forward as to inflation. Yes, it was rising, and we did in fact see the peak in inflation through the course of this year. And with that, market suddenly started to switch to, with the peak in inflation, won't we start to see the Federal Reserve perhaps starting to cut rates to anticipate growing the economy? And that's what we saw happen, and we did see the markets recover somewhat. Unfortunately, yes, and certainly Roger put up the graph that showed that inflation is coming off in the US. That's happening, and that did give the bulls significant, I guess, ammunition to suggest that the Federal Reserve would start to cut rates sooner rather than later. Unfortunately, I suspect that if we could sit here in 6 months' time, we'll probably be seeing inflation at about the same rate as we're seeing it now. So that means that sticky inflation is going to be with us for some time. The Federal Reserve has got a target of 2 to 3%. If inflation hangs around 4% for some time, that does mean that we are going to certainly not see interest rates come off. We're going to see them stay higher for longer. And in fact, if the Federal Reserve really takes case, then we will see them probably still continuing to lift rates for another couple of FOMC meetings. So what does that mean? It does mean that the S&P 500 is really not calibrating in the impact of fixed interest yields rising. They are looking more towards the future and saying, well, rates are going to come off, so we're going to calibrate the markets higher because we will see lower rates. If we extend those higher rates out, at some point in time, the market will recalibrate. And unfortunately, when that happens, it will be to the downside. So overall, we've seen the market in two minds, and whenever we've seen the Reserve Bank or a federal bank coming out and suggesting that they are looking at perhaps pausing, we've seen that surge in market sentiment driving it higher, and then they come out and actually cut rates. They raise rates, and we see the markets react accordingly to the downside. So overall, one would have to suspect, given that we are still with the Federal Reserve and our own Reserve Bank in a tightening cycle, that at some point in time we will see the equity markets, the S&P 500 and our own ASX 200 actually recalibrate to those higher rates. In the meantime, we've had a rush of what we'd call, and Roger talked about this, the breadth of the market. We've seen a handful of stocks, the Apples, the Microsofts, the Amazons, the Googles, really dominate the market, and they've dominated primarily because we've suddenly seen a flashing light called artificial intelligence. It's been with us for a long time, but it is now starting to appear in mainstream operations across the world, in businesses and in all forms of life. And that's really what we've seen happen, that narrowness of the market, looking at half a dozen companies and driving the markets higher. And I think that's reflected, if we could go back and have a look at the performance of the NASDAQ compared to the S&P 500 and the Dow. The NASDAQ's really shot ahead 30%, if I can recall, and the others are still lamenting. So that would suggest to us that there is a very narrow outlook for the market. If we see those interest rates moving higher, those tech stocks will have to recalibrate their earnings lower as interest rates rise. And if they can certainly put the market up 30%, then they can certainly take it down probably by a similar amount. So look, overall, we're still remaining very negative on the market. All the pointers suggest to us that through the course of the rest of this year, we will probably see a correction coming. We will see the breadth of the market start to perhaps have more of an impact, and in fact those tech stocks start to move to the lower side. So I would have to suggest that being in the camp of the bears is probably the safer way. We've certainly at this point in time seen the bulls win, but unfortunately, as we all are well aware, you'll wake up one morning and the S&P 500 will be down probably 25%. Unfortunately for us, it goes down with the elevator and up with the escalator, and that's probably what's concerning markets. Hence, we'll remain very patient. We'll be looking for those opportunities to come as the market starts to wash through, and we then actually do see some real opportunity for the Federal Reserve and our own Reserve Bank to actually start cutting rates. And that's only going to happen when inflation is probably somewhere closer to their 2 to 3% target. In both countries, it's nowhere near it at the moment. So one would suggest more rate rises ahead, and at some point paying for the equity markets.
Yes, absolutely. Look, a couple of key points. Thanks, Dave. That's really good. A couple of key points for members. You're getting a lot of comments. I think it's going to be quite an interactive session today. But Neil made a good point. He said, are we to be fearful when people are being greedy, or greedy while others are being fearful? Well, Neil, you've got the nail on the head, because that's the famous quote from Warren Buffett, as most people will recall. And yes, at the moment, the markets are very greedy. So you have to be having a little bit of fear, a little bit of cautiousness, and it's important. And we are doing exactly that. And not FOMO, I know it's real, but not chasing this rally. So that's one point. But the second question just come through from, 1 second, let me just find the question now. I've lost it. Yes, here we are. Kev asked the question, said, you've indicated fat profits is in the bear camp. Yes, that's right, Kev. Would you please quantify to what levels you forecast both the S&P 500 and the ASX 200 will retreat, and by potentially when? Well, I'll quickly jump in, and then Dave, maybe I'll get your insights. But Angus, I'll just repeat what Angus has been saying for some time. We expect the S&P 500 to be somewhere around where you see these orange lines, and that's why we've drawn them, to somewhere around the 3,400 points, maybe 3,500 points. So if you look at a sizable drop, you're looking at about a 25% drop from current levels. So that's what we expect. By when? I suppose that's a hard question to answer exactly when, but we do think in the next sort of 6 months, this should happen. Maybe worst case, push it up to 9 months, but depending on a lot of things, how they unwind. Dave, would I be right in saying what I just quoted from what Angus has been saying?
Oh, look, certainly, yes. I think you are dead right there. The timing is somewhat difficult. We had thought that we probably would be, and we probably are in a mild recession already, but the data's just not at this stage supporting that. But look, overall, probably if we see those interest rates stay higher for longer, the market does have to recalibrate its earnings valuations back to those higher interest rates. It's not doing that at the moment. And when it does, and you can already see back in April, we had April 2020, we had a significant downward move. Unfortunately, the market is very unforgiving when it comes to falling, when it really needs to fall. And we've seen those significant falls in other years when we've seen a 20 or 30% come out of the market. It is unusual, but when the market does get things wrong, and we've been always suggesting at this point the market is probably focused on the wrong area of the yield curve. It's looking for rate cuts, not rate hikes, and we're still in that rate hiking environment. That's really when we do see those major corrections to the downside. So as Roger said, and as Angus has been saying, remain patient. Yes, it looks as though we're missing out, but boy, if we do see that correction over the next 6 months, it could be a major one. And as the market does move higher, it does stretch those valuations. It does mean that those Googles and Amazons and Apples of this world, which are on quite high multiples, will suddenly find themselves on relatively modest multiples. And if they, as I said, if they can add 30% to the market, they can easily take that away in quick time.
Yep, absolutely. Thanks, David. All right, just quickly on the ASX 200. Look, I won't spend too much time, but I think Dave's already touched on it. But yes, in October last year, we were at 6,400 points. We have recovered. We briefly touched 75, 7,600 points. Now we're sort of consolidating. I think a lot has got to do with what China is doing at the moment as well. So there is certainly one eye on China slowing down, and the other eye is, of course, on the Reserve Bank in Australia and the overall data. So, but for now, we feel comfortable with the ASX more so than the US, but time will tell. But we will still advise caution when buying anything new at this point in time. Let's move on to some stocks and sectors for now. I think that macro picture is pretty clear for most members. It's just a reiteration of what we have been saying. But commodities, let's talk about a few commodities, starting with, okay, well, let's go with US dollar first, because that impacts the commodities. So, David, how do you see the US dollar? We know last year it rose and rose and rose, as we can see on the charts. This year it's come down, still consolidating above the 102 level. How do you see the greenback in the near term?
Certainly in the near term, yes, it's consolidating where it is at the moment. That is primarily, as we've talked about, the US is still in a rate hiking cycle and it's keeping probably its rates higher for longer. That means the interest rate differential between the US dollar and all its peer currencies will remain in favour of the US, and that will keep that US dollar higher. Angus has certainly talked about that in his dailies in the near term. We have some concerns on the dollar, however, and we've talked about one of them already, the debt ceiling. That's been negotiated higher, and at some point in time the market is really going to have to take account of the US debt rising. Its debt repayments will start to really impact on revenues, but the real hidden factor is the fact that we do believe that over the course of the next probably 12 months we will see a shift away from the US dollar as the trading currency of preference. We have seen in some countries already a move away from using the US dollar as a trading currency, and that probably will continue to gather ground. So overall, we expect the US dollar will over the longer term weaken as the debt ceiling starts to concern markets, as the currency shift from the US as a trading currency moves away to other currencies. And also, of course, the sticky inflation will also remain a problem. So from that point of view, we would expect in the near term to see the US dollar probably stay around these levels. We are pleased that it's broken that upward rise that we saw through the course of the latter half of 2021 and all of last year. We are pleased to see that break, but at this point in time, it is consolidating because the US does remain in rate hike territory. And while that's the case, we can expect the US dollar to remain probably to the top side of 100, then we would expect to see it to the bottom side of 100 in terms of the index.
Okay. All right. Let's break it down into a few commodities. Let's start with the iron ore. But I know you've talked about it on the Monday webinar, so maybe some members did not tune in. But China certainly looks, the slowdown in China is something we've all heard about in the last month or so. Iron ore has been up and down. They are trying to do a few things to revive the economy. Iron ore is still okay. So what are your thoughts on the overall commodity price before we look at Fortescue, for example?
Just quickly, iron ore, yes, it's not done too badly in an environment where we've seen rising interest rates. It would tend to reflect the fact that equity markets are still also performing quite well. But the iron ore itself, yes, China is pulling levers. It's got a 5% target growth rate for its GDP. It is gently pulling some levers to ensure that growth doesn't stagnate or perhaps fall. And one has to remember, China is now a significantly sized economy compared to where it was 20 years ago. So 5% growth is going to bring through significant volume increases, even at just 5%, that modest rate of growth. The rate of demand for iron ore, actual tons, will increase significantly. And that's what you've got to be very careful of when it comes to China. Yes, they have been slowing somewhat, but they are changing that now with moving their credit settings, etc., over the last few weeks, and we will continue to see them do that to hit that 5% target. That 5% target on a very big economy is going to do nothing more than just increase the volumes required to actually satisfy that growth, and that's really why we've seen iron ore not collapse. It's still trading around that 113 US a ton region. It's not gone sub 100 for some time, and it probably won't likely, given, as I say, you can't build an iron ore mine in 3 weeks. It does take several years, and if demand does continue to just on a volume base increase because China's growing at 5%, that's going to keep prices well supported.
Okay, excellent. If we get support, then I guess the likes of Fortescue Metals, so we'll just talk about one stock today. We know we've got BHP and Rio as well in the portfolio, but Fortescue Metals, just briefly, for those people who are holding it or maybe considering it, look, the last 12 months, this is a 1-year chart. Yeah, it's gone down to about $15 at some point, but it has recovered. It's now $22. All in all, how do you feel about Fortescue, Dave?
Look, Fortescue, very good stock, and the same for BHP and Rio. The primary reason is that the three of them are very low cost producers. And when you're getting $113 US a ton, then you're still going to produce very good margins. So from an earnings point of view, yes, we won't see earnings significantly grow because there are other factors such as cost pressures that are pushing up. We won't see earnings grow significantly, but as you can see, Fortescue is not very far away from its record highs. And that's primarily because markets are looking at what China's doing. They are looking at the fact that if there's significant improvement in volumes just because of the size of the economy and them growing at 5%, then that's going to flow through to the pricing side for iron ore, and that will be a benefit to Fortescue, Rio and BHP. So look, overall, as long as China is growing, and there's certainly all indication that they'll try and engineer that, if nothing else, then that's going to keep these stocks somewhere near their highs. We've been cautious at the moment with all of them because they are near their record highs, and we have gone through quite a volatile period. And of course, we're in the bear camp, so we've had them all on hold, just pending, waiting for some clear air to see if the Federal Reserve and our Reserve Bank at some point in time actually signal, yes, we've finished with rate hikes, the next move will be down, and that's probably when we'll start to see more pressure to the upside on the likes of the commodity prices and also commodity stocks.
Okay, excellent. Thanks, Dave. Moving on to gold, which is, I think, a favorite commodity for a lot of our members, because I'm pretty sure most members that we have are holding some level of gold in their portfolio, whether it's gold bullion or gold stocks. Look, gold, this is again, a sort of 3-4 year chart. You can see gold has hit, 3 times, it's hit over $2,000 an ounce. It's just a little bit below that in the short term, and I know Angus has talked about it in the last few weeks that gold in the short term might just consolidate a little bit further down before rising for the remainder of the year. Could you give us your perspective on gold? And in fact, I might ask a question which was asked by James earlier. He said, I've got Gold Road, Newcrest and Northern Star, and they're giving back much of the gains in recent times, Gold Road in particular. Can we expect gold stocks to pick up later in this year?
Oh, look, certainly, yes. If we're right, we do see the US dollar weaken at a later time in this year. That will be a tailwind, for the gold price. There is an inverse relationship between the two, and we will see the gold price recover. You can see when we did see the US dollar actually weaken off that we saw a commensurate rise in the gold price. So at the moment, as I've said, and we've talked about, the US dollars on the higher side at this point in time and not weakening, and that's really what's driven the gold price to where it is today. But if we are correct, our call is for that US dollar for the reasons as we've talked about to fall, then that's going to be a very good tailwind. And one would expect as a producer, and like with our iron ore producers, a lot of our gold producers are very low cost producers. And if we do see gold prices, and one's got to remember, you've got to also measure our producers, a number of them, in Aussie dollar gold prices, and that's been between 2,800 and 3,000 Australian dollars an ounce. And really that's been what's been giving our gold price companies certainly very good support. So overall, we would expect to see them pick up, and primarily if they've increased their production profiles over the course of the last 12 months, and we do go into that rising gold price, that amplifies the earnings that they will be reporting, and of course the share price as well. So we're very positive longer term, and yes, Roger, you're dead right. In the near term, US dollar is the king at the moment, and that's just putting pressure on the gold price. Until we see that change, then we will see the gold price just probably consolidating where it is.
Okay, perfect. And just briefly, look, Northern Star, I know we probably won't talk too much about it, but Northern Star is one of our preferred gold producers in our portfolio. We have a buy rating on it. So if you are looking for one of many gold stocks that we do have, Northern Star is certainly one to check out. It has had a good run in the last 12 months, as you can see, down from about, $7 or so at its lowest, and it's now about $13. Yes, it's come down from 14 down to 13, James. I know what you're saying, but look, if you picked up anything around $7, $8, $9, $10, $11, anywhere around those levels, you're probably feeling okay. Short term, it might show a little bit further weakness if gold price comes down a bit further. But look, we're expecting this for the longer haul, for this to continue its uptrend over the next 12 months. So hold these stocks. Last couple of commodities before we talk about other topics is lithium and nickel. So maybe just a brief word on lithium, Dave. It did fall down quite hard over the last 6 months or so, but is now recovered quite a bit. Lithium stocks in particular have also jumped back to all-time highs. How do you feel about lithium at the moment?
Look, just very quickly, yes, the fall can be attributed to the fact that the markets reacted too early to what's happening in the auto industry and the sea change there with batteries coming on stream. They lifted the lithium price long before demand actually started to kick in. We have now started to see the auto industry moving into production of electric vehicles, not helter-skelter at the moment, but certainly it's going to be moving that way as we see mainline production of electric vehicles starting to come into play, and we've seen the recovery in the lithium price accordingly. Not back to those heady heights, but certainly to probably more sustainable levels that we see it. So overall, we'd expect to see that demand for lithium over the course of the next several years as the switch starts to occur in the auto industry. We will expect to see the lithium price probably on a more upward trajectory, not as rapidly as we saw back in 2021, but certainly on a more sustainable price increase over the course of time. And like we've talked about with the gold and with iron ore, operators such as Allkem, they are very low cost producers. IGO, very low cost producers. When you see a trending price to the upside, it does wonders to their financial numbers and of course the share price.
Absolutely, and Allkem, as we know, that they're now merging with Livent, and currently Allkem is the 4th largest producer in the world. This is the list of the biggest world producers for lithium, and you can see Livent towards the end of the top 10. Combined, they're going to make a new company called Nuco, which will become the 3rd largest lithium producer in the world, and that's something towards the end of this year. All in all, Allkem has had a fantastic run, so if you're holding it, we suggest to continue to hold, and it's now making new all-time highs, and we see this as a positive opportunity for them. And final commodity is nickel, which is pretty much the cousin of lithium, if you like, similar sort of setup. How do you feel about nickel? And then we'll talk about IGO as well, please.
Just very quickly, nickel, you can see the speculative spike at the same time as we saw the rise in the lithium price. Unfortunately, the speculators in nickel are far more prevalent, and you can see the adjustment back when the markets realized that they had moved too quickly in anticipation of rising demand coming out of the auto industry. We are perhaps now seeing a more realistic market, as we've seen with lithium. There's probably a greater volume of lithium required to go into an electric vehicle than there is nickel. Hence, you saw the lithium price recover. We haven't seen that same recovery in nickel, but mind you, there is still a good quantity of nickel going into lithium-ion nickel batteries. So overall, with the other demand that we're seeing picking up, especially steel, nickel's a good protective of steel, then we would expect to see over the course of time demand improving, and with that the nickel price.
Yep, absolutely. IGO is one stock which I'm sure a lot of members are holding, or at least looked at. Look, it's currently hold. We're not buying it anymore at this point in time. If opportunity does present in the future, we may turn that back into a buy, but at this point, it is a hold. So if you're holding it, good for you, because certainly has done quite well. One final stock on this before we move on to other topics is Essential Metals. Quickly, Dave, if we can get a word on this, because I know some members are holding it. Yes, they had an offer to be bought out at 50 cents, which they rejected. It's obviously now down a little bit, around 43 cents. What are your suggestions for members for this stock?
Look, they have a very good lithium project in Northern Dome, and we think that they'll continue to expand the lithium inside that particular project. IGO made an offer at 50 cents, so they certainly believe that there's a better value than the share price reflects at the moment, and we do believe over the course of time that they will continue to expand that lithium lithium that they've got at North Dome, and that will continue to add value to the shares over the longer term. If we're right and we do see demand for lithium improve, then certainly exploration companies, and it's been a bit of a tough battle for exploration companies over the course of the last 6 months, we'd expect to see as that outlook for lithium improves, that certainly exploration for lithium will also improve in value, and that's why we continue to support Essential Metals. We have it as a hold at the moment because it has come out of that takeover play, and we will be looking at that recommendation in due course.
All right, excellent. All right, let's move on to the plan now. Now, we've covered the macro so far today in the webinar. We've talked about a few sectors that we like. Let's talk about the plan for the remainder of the year, because if we are right in this bearish view of the market, and it looks like majority members agree with our research, well, what is the plan? So there's a few things to look at as an investor, and one of them is to remain defensive, to raise cash levels, and we'll talk more about cash levels in just a second. Avoid speculative stocks unless you have to, then that's okay. I mean, there's always ups and downs in that space. And more importantly, staying patient. And I think Lynn mentioned earlier, FOMO, that's something to keep a very close eye on. So breaking it down, how do you stay defensive? Well, typically your large blue chip stocks paying good dividends, low debt, good PE ratios, decent earnings, that's your good defensive place to look for. I mean, i.e., BHP, good PE ratio, good dividends, largely positive cash flows. Those are the type of stocks which in this market are good defensive stocks. Here's a few examples that you may know, some of the banks, Spark, New Zealand, Telstra, etc. So hold on to your defensive stocks. Number 2, cash yourself up. And yes, this is important because, of course, volatility brings opportunity. How much cash is important? Well, that's where everyone's going to be slightly different. But we know the bull market is coming. It always comes at the end of every bear market. That's just how cycles go. So for the bull market, Angus has been on record for many months now saying he's sitting on about 30% cash in his portfolios, and he's waiting patiently, I might add, waiting for those opportunities. Now, we are open to admit that we were expecting this final sell-off in the bear market to happen before June, as one of our predictions at the start of the year. Hasn't happened yet, so we're happy to put our hand on heart, say, look, haven't got the timing right yet. However, we will wait. And when that does happen, then we will use that cash. So at the moment, cash is still generating some interest, at least not as bad as a few years ago, but we're happy to hold on to that cash. May I put in in fact, let me just carry on. I'll pop a question in a moment. Number 3 is avoiding speculative growth stocks. Now, this is something which normally in a bull market are very good to add to your speculative stocks. In a bear market, volatile market, they can be hit and miss. So you've got to be very careful. But if you want to have a go, no problem. But make sure you are investing accordingly, not putting your house on, of course, on small speculative stocks. And last but not least, staying patient. Now, we've got a number of stocks, as you know, on hold. Number of stocks we are holding fire on. We're also looking for new stocks. There's a number of stocks that we are researching at the moment that we want to pull the trigger on, but we're holding back. So that time will come when we'll turn a lot of stocks into buys. And that will be certainly where cash will come into play. The other thing to look at is you may want to look at dividend stocks through our income report. Now, most of you would know every quarter we publish an income report with an income dividend portfolio, and this was recently updated last month. The portfolio looks like this. If you haven't seen this, I encourage you to jump on the website and find it. If you can't find it, let us know. But there are 21 stocks in this portfolio, all within the top 200 on the ASX. We've been running this for 11 years, and this is on the website. It's a model portfolio for you as a member to try and either copy or even cherry pick the stocks out of. It's been producing pretty good returns, as you can see, 13.7% per year for the last 11 years as an average. So if you really want to follow some of the recommendations from this, you may. But here's a quick snapshot of the current 21 stocks. You can see the financials, industrials, and property on the left, and you can see the dividends per stock. The interesting thing is the gross yield for financial year 23 and 2024 for each stock, and then you can see the portfolio average at the bottom. So you're looking at over 6% in gross yield across the portfolio. Of course, some are higher than the others, so you can cherry pick a few, but these are good quality defensive stocks. Most of them have done very well, so you may get some ideas on defensive stocks from this as well. Now, here's a question for you. Let's put this up, because let's, as I said at the start of the webinar, let's make it interactive, right? Let's make it a bit of fun. So how are your cash levels at the moment? So let's get a feel. Now, you know what Angus is sitting on. I've just mentioned that earlier. He's sitting on close to 30% cash. Now, some of you, of course, might be less or more, or not at all, or whatever the situation is. So let us get a feel, because if 37% of you are in the bearish camp, we hope that you put some cash on the side ready for some opportunities. So that would be the playbook, and that's something we're banking on. And if, of course, if that call is right, then that would be very nice to buy quality stocks. And most of you would remember March 2020, when the stock markets dropped, 30%, 40% in a month. That was a great time to buy quality stocks, and that was recent memory. So on that note, let's close it and get the answers. Here we are. So 7% of you are fully invested, 17% are less than 10% cash, 40%, this is the biggest chunk, between 10 and 30% cash, and 33% are 30% plus cash, and only 3% are all cash. Okay, well, hopefully that gives you an idea of thousands of you on where you're sitting at. But I guess if I was to summarize this, then 40 plus 33, that's 73% plus 3, 76% of you are more than 10% in cash. So that's a big majority. So good luck to all of us, guys. If we get this right, we could make some money. Let's look at a few more things. One of the things I'm going to show you in a moment is a model portfolio, or at least some ideas on how to construct a model portfolio. So stay tuned for that in a moment. But before that, let's look at some rules for long-term investing. This might be a refresher for some of you and might be new for some of you. So here are some rules for long-term investing. First, only risk what you're able to lose. 2, reinvest dividends to own more shares. I know a lot of people do reinvestment plans. 3, invest in the things that you understand. I know a couple of you were asking about cryptocurrencies earlier. Look, one thing we always say, if you don't understand it, if it's too complicated, don't go there. Just keep it simple. 4, diversify amongst different sectors and markets. Very important. 5 is create a plan and stick to it. And number 6 is avoid panic selling during sell-offs. And that can happen to the best of us. So stick to those plans. And here's this chart that you may have never looked at. The best performing stocks in the S&P 500 over the last 15 and 20 years. And the reason we're sharing that with you, just to show you what can be achieved if you hold stocks for a long time. So that on the left is 15 years. You see the names like Netflix right at the top, 7,000% return. Nvidia, which is now going crazy, 5,500 returns. And these are some names that you're probably familiar with. Apple, Amazon, Domino's, and Monster Beverage Group, which is the drink company. Some huge returns over time. And if you look at the 20-year chart, then you'll notice that Apple and Monster is obviously crazy. I mean, 130,000% return, that's just unheard of. But Apple, household name, 61,000%. I guess the point we're trying to make is that if you have a good long-term plan, I mean, some of you might be holding Commonwealth Bank from the 90s at $5, today $100. Some of you might have bought CSL at $2 or $3 and might be holding it today at $300. So we all have some success stories, but I think they only happen if you have a long-term plan in place, you stick to some rules, and you avoid panic selling during sell-offs, and you average over many, many years, as many times as you can. So this is hopefully a good exercise for you to remind yourself that long-term does work. Now, On that note, we're going to talk about the service now. And this is where I want members to provide us some feedback. Now, members, you know, this year we've made several changes to the service, all to improve your experience, all to make it easier for you to absorb the information that you pay for, the research that we do for you, cut down your time, and improve the quality of information. So first, one of the changes we made was we put highlights at the top of every daily FAT chat, just makes it easier for you to see, okay, what are we talking about? We're making them shorter and punchier, less information, still quite a long email, but a lot less than previous. But we're still looking at making several further changes to the daily FAT chat. The second change we made is the webinars per week. Now, you know that last year we used to do one webinar per week where we consolidated everything in the one webinar. We've done 2 webinars now, Mondays for stocks with the research team, Thursdays with Angus for macro. So hopefully you're finding those 2 beneficial, because you might like one or the other, or you might like both. It provides you different options. Third, we've got plenty of people coming through the webinars to provide you different perspectives, different communication channels. So you've got, of course, you know, Angus, David, Patrick, our CEO, came along to talk about wealth management, and of course our analysts as well. The other change we made, which is a significant change, is previously we used to do stock recommendations once a week, and most of you will remember that from the past. Is on a Wednesday and a Tuesday we used to publish the Australian equities and the mining reports, and we send you reminders that stocks have been updated. Now what we do is we do them daily in real time. So if a stock, something's changed today, we'll publish it today. We won't wait till the following Wednesday, because that's a few days away. So we've done it on a daily basis. It does put us obviously on the hook, because we've got to do something quickly on the day, but again, to make your experience better, so you're getting the information on the day, and you get that in the daily email. Another change we made is we're doing a lot of midweek alerts, as you may have noticed. Yesterday we sent out Telstra or TPG midweek alert, which might have hit your inbox. Mincor was a recent one as well, and you can see the list. This happens when a stock goes up or down more than 10% on a day. So that triggers a midweek alert. We want to let you know good or bad news and what's changed. So hopefully you find that useful. That's something you can act on. Fat Wrap. On a Friday, we do the highlights of the week that you may have missed out on. All the links are there on the Friday. You can click them, and if you missed out on anything, it's a good reminder. And the recent change we made on Sundays, you may have looked at the last 2 Sundays, we've sent you an email with all of our stock updates during the week. Now let us know how you find that, because it's only new, something we're trying to see if you're getting a good response. And we'll put all the stock updates for the week in that one email, and the links are there. So if you want to look at Azure Minerals, or you want to look at Sonic Healthcare, or whatever, you can click the link and it's right there in your face, so you can read it. We've also made a lot of changes to our charts in our weekly report. So now you see a lot of technical analysis being done, including support, resistance, breakouts, golden cross, death cross, you name it, moving averages. So a lot of technical analysis. Again, we do all that behind the scenes to make it easier for you to view it, make up your mind, you like it, you don't like it. Okay. And finally, of course, we've been selling a lot of stocks in the last 12 months to raise the cash levels. And you can see that through our alerts, to our recommendations, and we've done that. And we are going to do more sales before the end of the financial year. So in the next week or so, not much time left now, we're looking to sell a few more stocks and to just balance out the portfolio, and also raise the cash levels, because we want to make room for some new stocks. And trust me, we've got some new stocks coming when the opportunity presents. So we're making room to bring them out for you. So on that note, here's a question for you. What are your thoughts on the service changes we have made this year? And again, please be open and honest, because we appreciate all the honest feedback. We do all of this with the view that your experience is right at the heart of our service. So all of our meetings, all of our discussions in Fat Profits are to improve member experience and make it easier for you to absorb the information. So we'd appreciate any feedback. If you've got anything outside of this webinar, feel free to email but we'll be happy to take that feedback on board. All right. David, while we're getting that question answered, any thoughts on changes? Because we made several changes which affect you as well, because you're under the pump every day. You've got to ride up every day and you've got to turn up every day. So how do you feel about the changes so far?
Oh, look, certainly, hopefully the changes that we're delivering will bring, as Roger said, the experience of what we're doing and the ideas that we're trying to put across in the market to our members in as quick a time as possible. We'll continuously publish our reports going forward, and that does mean that we won't be writing them and waiting a week to publish them. They'll be going out straight away. So look, overall, hopefully it is, as Roger said, it will bring that experience to our members a lot more quickly, and hopefully you'll be able to navigate your way around through selecting the report that you may wish to read, or all of them, a little more succinctly than perhaps you have been able to in the past.
Absolutely, thank you. I'm going to close this now. Thank you for the feedback, and again, being open and transparent. 82% of you, and this is really, well, just say heartwarming if you like, 82% of you are happy and they're saying good changes this year, and that is a big chunk. So thank you, members. 10% are neutral, 4% are saying can be better, and 5% are saying I have some feedback. So look, we're very happy to take any feedback. So for those of you who have feedback, please email members@fatprofits.com.au. We're happy to improve the service. But look, if 82% are happy and 10% are neutral, I think that just gives us a good idea on how the service has been going. So look, thank you for that. Now, I did say earlier, we are going to show you a couple of portfolios to talk about and give you some ideas today before we do wrap up. So let's go into that. Now, we know the bull market's coming and we know what happens. Just one last thing is, when a bull market does come, and this is something you must keep in mind, because as an investor, this is historical returns, and this is what you need to look at, is the 12-month return after the market bottom. Usually you see a 36% increase in the S&P 500. That's huge, from market bottom to the following 12 months. This is across the board, right? If you're 1 month early or 1 month late, you're still looking at 21 or 27%. If 3 months too late, 6 months too late, you're still looking at 20% plus. All in all, those of you sitting on cash, which a lot of you are, you're looking at 20% plus returns at the end of the bear market. So this is very exciting. Of course, a lot of money to be made. So that's something we want you to be prepared for. So just keep that in mind. And of course, invest in yourself, your education, your learning. And thank you for taking part in today's webinar, because this is all part of you just investing in your own education, own learning, just reiterating something that you already know perhaps, just telling yourself again that I'm on the right path. Now, to finish off, let's look at portfolio positioning. Now, of course, you all have portfolios. Some of you might have too many stocks, too less stocks. Some of you might have a fantastic portfolio. So the thing to look at is, where am I placed well? What are my strengths in the current portfolio, and what's the weakness? How can I improve the weakness and do better? And of course, that's what we want to do. So let's quickly ask one question here. In fact, no, let's just go straight to the portfolio. I'm going to show you the portfolio. This is one example of a portfolio review that we have done for one of the members, right? Now, most of you would know that we do portfolio reviews. We started this service last year. This portfolio was in 2 pages. So this is 1 page. And then if I just jump on to the next page, this is page 2. So they had about 40 stocks, right? Now, if you look at the names on the left, you look at the shares, and on the right-hand side, you see the percentage weighting. So right at the bottom, Woolworths, WOW, was 8% of the holding. The rest are okay, less than 5%. If we go back to the previous page, you'll notice that BHP was 5%, the rest are all okay. So in terms of weighting, not too bad. They're not overweight other than Woolworths in one given stock. In terms of diversification, yeah, they had reasonable diversification. They had some miners. You can see the orange stocks there are all gold stocks. You've got some financials, they've got some industrial, so it's a reasonable spread, right? But one of the things we did for this particular member was to consolidate the portfolio down from 40 down to under 30. Now, more on that in just a moment. And the other thing was to reduce any risky stocks that they're not doing well in. So if you're not doing well in a few stocks and they're not, the forecast is not that positive, well, it's better to cut the losses now before they go down further. So just consolidating a little bit, moving any risky stocks out of the way, and continuing with your strengths, working on the weakness, and just improving the health of the overall portfolio. Here's the next portfolio. This is just one page, so less than 20 stocks. You'll find this one probably a bit more consolidated. Two things completely stand out here if you look at it. AKE at the top, 34% of the portfolio. Big red flag, but good when it comes off. Of course, bought it at $2.40, $14.20 at the time. Yes, it looks great when it comes off, but still quite risky. We don't normally suggest that. Gold Road 5%, that's okay, but you got the 4 gold stocks in red. Right at the bottom, Woodside, 9.5%, so that's a bit on the higher side. All in all, reasonable portfolio, good size, couple of stocks out of whack in terms of weighting, but a reasonable spread. So what's the lesson? So here's an example of what you want to do, and you might want to look at that before the end of June. Is how to construct a portfolio. Firstly, start with a plan. What is the long-term plan? Have a think about that. Number one rule as an investor, protect your capital. And what's rule number 2? Don't forget rule number 1. that's the obvious one. Protect your capital. Research your investments. Part of your research, of course, is your own research. Maybe Fat Profits helps you, maybe some other sources. Make sure you do your proper research. Well diversified, have a few sectors across the board. We quite often see people too concentrated on one particular sector. Banks, maybe they're overweight in banks, overweight in BHP, overweight in CSL, overweight in Commonwealth Bank. It is so common, something you need to always think about. Ideally, 20 to 30 stocks. That's an ideal number. So have a think about that. Where do you stand versus that? Consider the long-term plan. Always make sure you're thinking long-term. And finally, always monitor it regularly and rebalance. And this is a good time now to rebalance before the end of June. Now, one of the things we're offering today, and this is good news to add value to your service, is the end of financial year, and we're offering some loyalty offers up to 50% off to add value to your service. So I guess the question you need to ask yourself is, do you see yourself using our service in the future? If the answer is yes, then would you like to save some money on the subscription? And of course, I've assumed the answer would be yes, because why would you want to pay more? So here's the 3 or 4 options. And we've got the standard membership, premium membership, and the platinum membership. You know which one you're in. Premium gives you 2 portfolios, the Australian equities and mining, or global equities, or platinum gives you all 3. Standard gives you 1, right? You know the drill. So one of the options we're presenting to you is you can now show us your interest on either taking on a subscription for another 1, 2, or 3 years, and we can offer you some really good deals. We can also offer you, if you didn't know, we can offer you a portfolio review service. And if you really want to get it done now before the end of financial year, that is a good time for 2 reasons. One, we can give you a tax invoice, which you most likely will claim as a tax expense. But 2, you might want to offset your profits versus losses and just balance it out before the end of June. So if you want to take advantage of that service, we're offering up to 50% off that as well. So both are very good options. And if you really like to add some value to your overall experience and you want to see yourself using us in the future, then this is a good opportunity for you to do so. So on that note, I'll take 1 or 2 questions while we get your selections. So David, maybe I'll take 1 question for you. In fact, just before that, I'll say, John just made a comment saying, well done, Roger and David. Suffice to say, I really enjoy being a Fat Profits member. Thank you, John. Peter saying, I really enjoy the changes this year to the service. Keep that going. Thank you, Peter. I'll take a question. In fact, there's quite a few questions. Give me 1 second. Okay, Allchem, AKE. So Robert's saying, hold Allkem or should I take some profits?
Look, at this stage, we've got it as a hold primarily because we do think going forward that there is further valuation increases to come as lithium prices steady up and then continue to rise over the course of the years to come. However, we're circumspect that the AKE is already near record highs in terms of its price, and we've just got to be careful about, as we've talked about, a pending move to the downside in the market. Unfortunately, if that happens, it will take all boats with it to the downside, and we're just being very cautious at this point. We've kept it as a hold for some time. The lithium price was at record highs for most of last year. It has come off, and yet AKE hasn't come off at all at this point in time, so one has to be cautious, and we hold it.
Okay, great. Next question regarding gold stocks. So Ian said gold stocks are not typically defensive, so should we reduce holdings in gold stocks?
Look, in the near term, one would suggest that yes, we think that the US dollar is going to remain firm, but over the longer term, we do believe that there is certainly better value to be had. And when you look at our Australian gold producers, and we've got a significant exposure to the Australian gold producing sector, it is that Australian dollar gold price that does drive them at some points in time in different directions to what perhaps the broader US gold stocks are doing. So overall, we'll remain well exposed to the Australian dollar producer sector of the market, and we do expect that the Australian dollar gold price will again test that 3,000 level. And with cheap producers, that does produce significant margins and cash flows, and we hope rewards for shareholders, or also the opportunity for gold companies to expand their production profiles going forward.
Okay, well, there's several questions that are coming through and have come through, so I apologize in advance. I don't think we'll be able to get to all the questions. There's about 75 questions still unanswered, guys, so I apologize in advance. I'll do my best to answer a few more. So just quickly, David, on Newcrest Mining, Lyndon asked, are Newcrest fully priced due to a takeover action? They also asked for Origin Energy, but I know we don't cover it. But are they fully priced due to takeover action?
Yes, look, they probably are at this point in time because they will move with Newmont, and Newmont will move with Newcrest. But the big driver there will be Newmont, and we've seen that gold price come off. So we've seen obviously some slippage in the value of the takeover. Because it is that, it's an all-share takeover. But look, going forward, we think that Newmont will certainly bring Newcrest into the fold. It needed to acquire something the size of Newcrest to impact its growth profile. It has got very good projects. With Newcrest on board, we think with the cash flows that they generate, we will see some good value come out of this company in the future. That's Newmont, that is, not Newcrest, because the takeover will complete.
Okay, excellent. I'll take a couple more questions and we'll wrap it up. And just on the answers to the question in front of you about the end of financial year discounts, one of you, I think it's Jonathan, just said, I think I've got about 5 months left on my current membership. So if I take up a platinum membership, what happens to those 5 months? So just to let you know, Jonathan, yes, you don't lose any time. So if you want to take advantage of the end of financial year discounts, say for example, you took on 2 or 3 year membership, we will be adding that on top of your current time. So you don't lose any time, we simply add it as a top up. Okay, so if you are interested in taking some discounts, please let us know. Next one is for, where are we? Jesus, so many questions, sorry guys. About gold. So Lynn's saying, what's the weighting to gold that Fat Profits has in their portfolio? David, any clues?
Look, at this stage, we are overweight that particular sector in the portfolios. We are not an index hugger, so we generally don't look at our weightings broadly speaking, but we certainly keep an eye on them when it comes to where we think thematics are moving. We believe gold price in Australian dollar terms is going higher over the course of the year to come, and with that we have very good exposure to Australian gold producers.
Okay, great. So look, I'm going to close the question now. I think everyone's voted. Plenty of people have shown interest in the membership options, and I'm actually surprised a lot of people have gone with the portfolio review as well. Look, maybe it's time to do a bit of a health check on the portfolio. So look, we're happy to help. and we will get in touch with those of you who want to get a one-on-one done with your portfolio and get you some recommendations. So look, on that note, as I said, I do apologize in advance. There's a lot of questions getting unanswered, but look, we're just way out of time. But look, if you have any questions, please can I encourage you to either call us, and we're happy to get on the phone, or you can email members@fatprofits.com.au, and we will get back to you. So on that note, look, I hope you got some value out of today's webinar, and I know Angus wasn't here today, but hopefully David and I have done a reasonable job to entertain you, but also more importantly, provide you some information that was invaluable. So members, thank you once again. We'll catch you next Thursday with Angus, but in the meantime on Monday with the research team. In the meantime, goodbye from me. My name's Roger, and I'll pass it on to you, David.
Yeah, look, I'll say farewell as well. Thanks very much, everyone, for listening in. And certainly I'll be back on Monday with the research team in our webinar, Talking Stocks. And we hopefully will see the shortest day, which is today. And from here on in, we're heading for summer. So let's get into it.
Absolutely. Bye for now.
Bye.